It'd be nice if we all had enough money in retirement to put it in a term deposit and forget about it. Unfortunately, this isn't the case for the vast majority of us. The only surefire way to ensure you don't outlive your retirement savings is to put it to work by investing. In this video, we unpack the 6 most popular asset classes and what they mean for retirees. And as always, stick around to the end of the video to hear the one golden rule that should guide every one of your investment decisions. Now, there are 6 asset classes that matter to retirees, and these are broadly split into 2 types of assets: defensive and growth. As the name suggests, on one hand, they provide consistent income and some level of protection against market volatility, like we see the share market move every day. And on the other, they provide the potential for capital growth. Now, the first asset class we're going to talk about today is cash. We know we need this to spend, we need this to live our life and enjoy our retirement. But cash can also provide the benefit of security and the confidence to sleep at night. Knowing that there's enough cash in the bank to fund, say, 6, 9, 12 months worth of expenses is something that's incredibly important in our experience, advising hundreds of retired families. The second is one of the most misunderstood and underappreciated asset classes in my experience, and that is fixed interest or bonds. Now, bonds start as simple as a term deposit, and what a fixed interest investment or a bond is you as an individual or an investor providing a loan to another company, another person, or in many cases a government. In return for providing that loan, you're being paid a contracted rate of interest that is commensurate or supposed to offset the level of risk that you're providing. One of the big benefits of fixed interest, apart from the interest rate or the contracted rate of interest you're getting, is that it provides some protection against volatility, and that's because in most cases, it's not traded every day like a share or a stock or any type of other asset. The third and fourth asset classes are very similar and very much intertwined, and that's Australian shares and global shares. At their most simple, shares represent your ownership of the profits, growth, and revenue and dividends of a company, whether that company is in Australia or overseas. They can be both listed companies like BHP or the Commonwealth Bank, or unlisted companies like in today's case Virgin, for lack of a better example. When it comes to investment in Australian shares, you're investing in the companies you know, but maybe love and spend a lot of money or work with every single day. Australian shares offer retirees the benefit of both income and growth. And if you're investing in Australia and subject to Australian tax rates, you can actually get a significant benefit in the form of franking credits. We'll cover the detail of that in another video, but in general, franking credits can add as much as 1.5% to your annual returns as an investor in Australian shares. Now, perfect examples of an investment in Australian shares is Wesfarmers, so the owner of Bunnings and Officeworks, the Commonwealth Bank, BHP, and even Telstra as another example. Now, global shares, very similar to Australian shares, you're just investing in a much broader part of the global economy. So Australia represents only 2% of the global economy, so we're essentially looking to be exposed to a much vaster universe of companies, of sectors, and probably importantly themes. So examples of investing in global shares will be buying things like Microsoft or Apple, who we use and operate and do business with every day. And similarly, the nature of Australia is that a lot of our sectors and our economy is quite traditional and full of mining companies and financial companies, whereas investing overseas, you can get exposure to things like data centers, artificial intelligence, and even truly global retail brands like Louis Vuitton, for instance. Now, the last 2 asset classes are a little bit more complex. The first of those is real assets. And as the name suggests, this is tangible assets like property and infrastructure. So this could be an office block. This could be a toll road, an electricity grid, an airport. There's 2 big benefits of these. And again, similar to shares, the benefit comes in the form of both income and growth returns. But one of the big benefits of an investment in real assets is the consistent cash flow that you receive. You can imagine if you're owning multiple properties, you're getting the benefit in the form of rental payments. And in the case of infrastructure, most major infrastructure assets are subject to government regulation, similar to a toll road or something everyone would have experienced in Australia at some point. The benefit of that is that these companies are essentially guaranteed to be allowed to increase the amount that they charge customers every year, which means the income they can provide to you can also increase. And the last one, probably the most complex, is what we call alternative assets. And this is essentially anything other than shares and bonds, and ultimately things that react significantly differently to significant market events, that being, say, an election or changes in interest rates. Gold bullion is a perfect example of an alternative asset, and what we're seeking and the role these play within portfolios is to have lower correlation than the other investments in your portfolio. So if the share market or the bond market were to fall significantly, alternative assets would be expected to perform significantly differently and generally better if it was falling. and thus offering you some protection against that, but also the ability to sell these assets and then buy those markets at a lower value at some point in the future. Now, other examples are things, more complex things like hedge funds, overseas currencies, and even things like private equity and venture capital. Now, as I mentioned, there's one golden rule that I think is incredibly important and central to the success of every investor in retirement, and that is that asset allocation is the biggest driver of investment returns. We've learnt this over several decades of advising retired clients, and while it might be fun and interesting, and while a lot of us end up spending most of our time on stock selection, we know that the real driver of returns over the long term comes from asset allocation. That is the amount that you have in cash, in bonds, in Australian shares, in global shares, real assets and alternatives. And this is central to both navigating those periods of difficult markets, as we've seen at different points, including the global financial crisis, the pandemic, and even the increase in interest rates that happened in recent years. As always, if you have any questions about your portfolio or are looking for advice on your retirement, please reach out directly via email or via our website.